Welcome to a special episode of the Capital Gains Tax Solutions and Expert CRE Secrets podcast. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, financial, and business minds in the world. And today we have a special place. We're actually in the clubhouse as well with the one and only Logan Freeman. Logan, how you doing?
I'm happy to be here, man. I'm very excited.
Excellent. And we're doing this every Friday, 8:30 a.m. And you can find us basically searching 1031 exchanges. Today, we're diving right in. We're going to be talking about the 3 investments to insulate your portfolio. And for those who don't know Logan, he is a specialist when it comes to all things commercial real estate brokerage, development, ownership. He's out of the great state of Kansas, or great city of Kansas City. Although, Logan, I'm sorry about what happened on Sunday. How are you feeling right now? We might as well get that thing out of the way right now.
Yeah, we're a little bit sore about the game, obviously, and it's frankly, losing to Tom Brady is always a bummer. But if you're losing to the greatest of all time, I suppose that's the one person we want to lose to. So, we're gonna be in the hunt for a long time. We got a young quarterback. I feel very good about that. So I think we got a long track record, but would have loved to bring it back home to Kansas City. But it was fun just to be there again, for sure.
Well, thanks for sharing. And you absolutely got a first-class quarterback team, coach, everybody. I'm sure you guys will be there again. And sometimes it's just kind of something happens special, right? And that happened with Tampa Bay. And so you got to tip your hat to them. They played a great game. So that being said, are you ready to dive into 3 investments to insulate your portfolio?
Let's do it, Brett. So the first thing we're gonna talk about is a little bit about diversification, because you think about diversification, usually it's around the stock market and your stock portfolio, which is important as well. But I think that, diversification you can also think about in the commercial real estate side of things. And so, first, I think I'll talk about why a diversified real estate portfolio is better than a diversified stock portfolio. And the role of diversification in passive commercial real estate investments is a little bit different than the role that it plays with stocks, because the end game is different. The objective of investing in passive commercial real estate investments is to compound your wealth, not to merely maintain a certain level of return. So when you think about passive or active commercial real estate investments as a part of your wealth building machine, it feeds off the cash flow from a portfolio of investments. And we have spoken a lot about on this program here about looking at value from an intrinsic standpoint. So what is the value other than what the market is willing to pay? And so as you feed that machine of commercial real estate with cash, it compounds that cash through appreciation and the opportunity to reinvest that. Unlike with stocks, where diversification won't save you necessarily from a crash, we're seeing that in a lot of different ways right now. The way that Robinhood and some of the other social media, I think, platforms are able to impact your own portfolio. But diversification in commercial real estate has been proven to insulate investors from downturns, protecting their wealth building machine, because you can diversify across in commercial real estate, not only across geographic markets, but you also have asset classes and property types. And another way to diversify is obviously through different investment strategies. So you have value add, or you have more stabilized opportunities. So the right mix of those properties will ensure uninterrupted cash flow, or at least give you a lot more diversification. So, the biggest thing that I wanted to make sure that we talked about was, when you have the right assets in the right markets, your income may dip with some of those assets. Like, for example, we have 2 hotels here in the Kansas City market. Obviously, we saw a big dip in our income on those assets in our portfolio, but we also have quite a bit of multifamily. We also have office. So, some of those came to a screeching halt, but others performed very well. And so, I think, frankly, it's because people obviously didn't stop needing housing, and businesses didn't need to stop having places to conduct their businesses overnight. But it's a big piece of that. And what I wanted to also talk about was, commercial real estate being illiquid, meaning owners do not unload them in a crisis like with stocks and driving down their values. So I think we saw that in 2008. The latest pandemic-induced crisis has taught us not only that markets are not all markets and assets are equally affected by downturns. Some are more resilient than others. The Midwest, the Southeast has been performing very well on the commercial real estate side of things, in particular, the multifamily side. But the key is that you do not have to have all of your eggs in one basket when it comes to commercial real estate investing. So any questions or thoughts on that, Brett, before we get into the 3 different ways to insulate your portfolio?
Sure. A few things stick out, and thanks, Logan. Build the machine first and then cash flow, right? So you want to, whatever that machine might be, right? And most of the time, multifamily, value add, mobile home parks, senior housing, or something that assisted living, something that's going to cash flow massively and be able to, pay you an additional income stream, right? Of course, you're going to get the depreciation as well as a part of that. And then maybe even diversify, like you're saying, out of different product types. And in particular, some of them are going to be value add, some are going to be more stable. And so I think that's a great way to look at commercial real estate investing. Is that a fair summary, Logan?
Absolutely is. And, also we're in a point right now where it gives you a really great opportunity to look back. And what I mean by that is simply look back to, the last 12 months. And you can look back across asset classes, and you can also look back across geographic locations. And so I've been doing a lot of studying, not only on the target markets that we're in, but also the asset classes and the investment strategies that we are in. So for example, I've been reading some articles talking about the Class C multifamily market, where, you basically have a property that is still pretty market rate affordable, but it's very difficult to develop new product today with the cost of construction and labor that is going to allow you to have rents that stay affordable unless they are developed using a low-income housing tax credit development or some other strategy, which is a completely different conversation. And so you're able to look back during COVID, see how the different investment strategies or asset types that you're interested in have performed. And we have some really great data, I think, now, and some empirical evidence to go make informed business decisions and investment decisions this year. And I was talking to somebody in our brokerage earlier this week. They said, hey, how do you feel about commercial real estate in 2021? And that's obviously a very broad question, but the whole thing that I was trying to get across to them was, it feels like there's a perfect storm of, hey, we've got data to look back into. We can kind of see the light at the end of the tunnel. We're not quite there yet, but I think we're starting to see it much better than we did 5-6 months ago. We have a change in obviously our office of the presidency, and so that a lot of people are happy about that, or they might be upset about that. But at the end of the day, that being done and over with, paired with the fact that the stock market's price to earnings ratios are pretty high right now. Now, there's an argument to be had on that front that valuations have changed, and some of those businesses are pushing those price to earnings ratios up really high, and that's again another clubhouse topic to talk about. But all of those factors combined, people are starting to say, man, is there another option for me? Should I be thinking about a different investment strategy? And that's where I think we can lead into our next talking point, which is all about diversification options within the passive real estate investing market. And so where I want to start is public versus private. But before I do that, Brett, any additional thoughts or any clarification that you would like me to make?
No, I think you said it very well. And I think about the Robert Kiyosaki, Rich Dad, Poor Dad, and then just looking at what buckets your income's coming from, and then even inside of that, taking that to the next level, which is, okay, now that I'm investing in commercial real estate, or now that I am in brokerage, or I'm doing deals, what's like the 2.0 of that, right? And that's where it's kind of like when I first started out in finance or in understanding financial security. I start with Dave Ramsey. It's a good foundation to start with, but then how do you take it to the next level there, right? And how do you maximize the wealth that you're building? I had a good friend who just joined us here, and he's going to be investing in single family homes. He's going to be doing on a big scale, like $50,000 homes, and making like $750 a month on these duplexes per side. It's kind of an interesting strategy, and that just goes to the point of, hey, how are you going to diversify inside of your investment real estate portfolio? different states, different geographical locations, different abilities to cash flow. And so those are the things that stick out for me. But let's dive into that first one to make sure we hit these 3 points here in our time that we have here.
Absolutely. So in the passive commercial real estate kind of marketplace per se, investments are available both in the public and the private markets. So let's dive into how they stack up against each other in terms of diversification and the ability to withstand market downturns. So in the public, you have REITs, or real estate investment trusts, that are the principal investment option. In the private markets, you have real estate syndications and private equity that are two different alternatives. Fund structures, single asset syndications, Delaware Statutory Trusts. You have all these different types of options in the private markets, and some of those are public as well. But let's dive into the pros and cons of real estate investment trusts. So, the pros of these are, because REITs are publicly traded, investors can buy as little as one share of an individual REIT or the stock of that REIT, and theoretically, investors could buy multiple REITs without huge capital outlays to diversify their portfolios. On the flip side of the coin, you have the cons, right? So since they are being traded publicly, that can cause volatility by correlating to the entire market. So in a crash, REITs will not be insulated. So moreover, in a downturn, management always gets paid first. So that's the first kind of bucket, is the REITs. It's available to a lot of people. You can get exposure to those, and you can buy as you want or you want, and you have the opportunity to diversify that volatility that the stock market. You're still going to have that with a REIT to an extent, and so that's the first option, is the REIT. Now,
can I add one more to that? And maybe you're going to get this on the private side, but just no depreciation, right? So one of the number one reasons to own investment real estate, and it makes it very unique to just about any other asset class, is the ability to depreciate. So the REIT side is publicly traded, right? Therefore, in the way they structure it, you're not getting any depreciation. So if I put $1 million into a REIT, although it could be some fancy, nice real estate, guess what? I'm losing out on one of the number one reasons to invest in investment real estate, and that's depreciation. So dive right into that on the private side, Logan, for us.
Absolutely. So we're going to jump into syndications. So syndications are ubiquitous, right? So investments are available across every state, even offshore. My buddies do things not here in the States, and across all asset classes and property types. The opportunity for those investors to diversify through syndication is easily accessible. I think on that point, it is a relationship-based game. So you have to do some work and some due diligence up front to be able to get access to those different types of investments. And so you have to make a concerted effort to reach out to those folks. But additionally, because of a waterfall compensation structure that's usually pretty common in real estate syndications, investors come first, meaning there's usually a preferred return and then there's a promote structure above that. So basically, hopefully the sponsors that are evaluating investing with are tied to the performance of the asset. But in a downturn, even if profits are squeezed, investors will typically be the first ones to receive distributions. On the flip side of that, the cons of a syndication, one of the main ones is, in the hands of the wrong management, syndication can be absolutely risky. And so I always talk about folks need to find the right jockey that they feel comfortable with. The horses that we're all on are typically pretty similar, right? They play in different states, they have different arenas that they're in, but the jockey really is going to be who you want to hang your hat with. So doing your due diligence up front with those sponsors, with those general partners thinking about investing in, is so crucial to success. So that's when you start talking about track record. You start talking about the team, the systems that they have in place, the deal flow that they have. So, I think that's a very, very important part of that. So the cons of a syndication is you're not going to get a publicly traded, management team. You're going to get a guy like myself or somebody else that has a business, have people that work in that business, and it's not going to be the same experience that you would from a public side of the real estate business. But you're probably going to have better returns, and you're not going to be subject to the market. So my name, guess my number one takeaway here, Brett, on this point is just you really got to do some serious work on the front end when you're talking with the people that you're looking to invest in.
100%. And also you're going to get depreciation on that too, right? Whether you're a GP or an LP on that private deal. This is the beauty of going in, and I've invested multifamily,
Yep.
assisted senior housing, assisted living, and other assets as well. You're getting that depreciation, and that's big, right? Because you don't want to pay any more in taxes for every dollar that's coming in if you can have it depreciate. And a lot of these do cost segregation on these deals, and you may get, let's say you put 100 grand in, you're getting, I don't know, let's say $10,000 to $15,000 that first year, but you're paying zero tax on that because all of it's been depreciated on an accelerated basis. So that's powerful. But we're running out of time, so we want to go into 2 and 3. So what's number 2, Logan?
Okay, so the first one was REITs, second one syndications. The third one we have here is private equity, which isn't talked about as much. So the pros of private equity firms invest in other private companies that invest in real estate, not in property. So the benefit of investing in the right private equity firm with a diversified portfolio of private companies in multiple markets and asset classes is that reduces the need for the investors to invest in multiple companies themselves to diversify. And so this is a little bit of a different beast and a little bit of a different ball game. It's not necessarily on the real estate side of things. While those private equity firms can have holdings in real estate firms, they also have a lot of holdings in operating businesses. The cons of getting into private equity firms is typically the cost of entry is much higher than syndications. So sometimes these start at 200. One thing that's been really interesting to me with the silver tsunami of all the baby boomers that own businesses is getting the opportunity to these private equity firms that are actually purchasing these portfolios and overseeing the management of it. Just should be on people's radars as an investment strategy going forward.
So now let's break this down to what area, Logan, you like best, and perhaps how you help somebody decipher what amount. Let's say I'm I'm in my 30s or 40s. I've amassed $200,000 to $500,000 of wealth, and I've got about $100,000 of liquidity. I have a high risk tolerance, Logan. What would be your suggestion here? And a good understanding of commercial real estate, right? What would you be suggesting?
Yeah, I would say two things. The first being the fact that I like to start from a market standpoint, and so here's the deal. Like a lot of folks have issues investing out of the geographic location that they live in the commercial real estate industry. But you have to look beyond your local market and your core competency, because many folks live in great states to live in, but not great states to invest in. And so you have to make syndicators with those brokers that are connected to those new markets that you're interested in. So there's some great resources out there to be able to understand markets. What I can speak to, Brett, and why we have, I think, continued to have some success is we're not generalists. We're very much on the specialist side of things. So we're focused on Kansas City, and we're focused on commercial real estate, really neighborhood retail shopping centers and multifamily. Everything else is a shiny object for us. And it's twofold, because the first part is the choke point that we have on good deals that are happening in this market, and then our knowledge and relationships to operate in this market as well. So we're definitely specialized in that arena. What I would say when you're talking with people about thinking about getting invested into commercial real estate, really understand what their unique genius is. And for me and for our firm, it's Kansas City, it's commercial real estate. That might broaden at some point, but that's what we know best. That's our competitive edge, and that's what we're going to continue to work on and bring investors into the deals that we feel comfortable doing ourselves. So that's that's how I would break that down.
Mm-hmm. That's great. I think that all makes a lot of sense, and even more so for folks like me who's in California, in Northern California, where prices are so high. I'm just telling everyone, don't invest right now in California. It's just There's so much uncertainty, even with what's going on, and also the prices are so high. Go out of state, create those relationships. We're no longer, we can do Zooms, we can connect, we can get on a plane still and go figure this thing out. don't think too small, and really figure out the keys to relationships, right? I always say trust the sponsor and then trust the deal, or as much as you can, right? If you have
Yes.
those two things, you don't need to be on the ground all the time. You can partner and you can diversify and you can invest, and that might even open up more opportunities as well. I've invested in deals in Texas. I've invested in deals in Arizona, and of course California in the past. Haven't touched it in a while, so make sure that you are opening up. Logan, for folks who want to get in touch with you, and then we're going to open up for questions because we are running out of time here. What's the best place for them to find you, Logan?
Yeah, I am very active on LinkedIn. So everybody can find me on LinkedIn. Our website is ftwinvestmentsllc.com. But if you just search Logan Freeman, LinkedIn, Kansas City, my big mug will show up there. And I'm active over there every single day, multiple times, Brett. I appreciate that.
Absolutely. And then if you want to learn more about the Deferred Sales Trust or ways to save and fail 1031 exchange, you can go to capitalgainstaxsolutions.com. And as a reminder, every Friday, Logan and I will be here discussing investment real estate, 1031 exchanges, Deferred Sales Trust, and ways to grow your wealth individually, or if you're a business professional looking to add value to your client. That being said, we're going to open up for questions here, and let's go with anyone who wants to raise their hand. We got Andrew, we got Sam, Jason, Charles. I'm not sure how to pronounce that, but I'm going to say Yaki and Mark. Anyone have any questions? Go ahead and raise your hands, or comments too. You don't have to have a question; it can also be a comment. And while we are waiting, we can also potentially preview next week's episode.
Absolutely.
Which is going to be, and I'll just go into that unless I see someone raise their hand. So next week's episode, Logan, and just so you know our format, each week we are swapping, where Logan will be the kind of the host, and then this week I was sort of the host, right? And providing thoughts and value, hopefully all along the episode. So next week, Logan will be interviewing me and discussing the topic of the second secret in the 3 secrets of optimal timing transformational exit planning. Basically, secret number 2 is this: optimal timing. We're going to talk about what optimal timing means and how to create and clone a transformational wealth plan. And the secret goes along like this: how to clone a proven wealth plan with Capital Gains Tax Solutions and your trusted advisors in less than 5 hours, and become time, energy, and debt-free, and have the ability to buy real estate on your terms and on your timing. So that'll be next week's topic: optimal timing, transformational wealth plan cloning. That being said, it looks like we have no questions or comments from the audience, which is just fine. We have 3 minutes away. Logan, any last words for our audience before we let you go?
No, I would just say that when it comes down to investment decisions, you can be very pragmatic from a market standpoint and asset standpoint. But when you get into the private world, a new intangible piece really comes into play. And that's all about the people and the relationships and the values that they have. So make sure that you're asking hard questions, listening to those answers, and feel really strongly about the values of the people that you're investing in. That's what I would like to leave everybody with today.
Excellent. And that wraps up the show, wraps up the clubhouse, and we appreciate everybody. I'm going to see you